Get ready for a new episode of KP Talks Dollars and Cents. Learn financial literacy and get real-time updates on all things housing, finance, and real estate with your host, Kevin Perenio. As an owner and C-level executive for 20 plus years in finance, KP is here to serve you with all of his knowledge and experience. Whether you're a broker, realtor, or just interested in the economy, this is the podcast for you. So let's get started. Here's your host, Kevin Perenio.
Hey, it's KP coming to you live from Newport Beach. We are here at the Balboa Bay Resort, and we just had our sales rally for both the retail and then the TPO channels with correspondent and wholesale over the last couple days. And this is where we get to reward all of our top originators, top branch managers, account executives, regional managers, divisionals, everybody that kicked ass in 21. It was a fantastic year. And what a great event, great venue. Decided to give you a little scenery. You know, I don't like to plug my company often on these videos, but I'll plug some scenery. Balboa Bay Resort. Don't worry, I don't own any of those. You know what they say, boat stands for break out another 1,000. I think I'm too cheap for that, to be honest with you. Anyway, hope you're enjoying the view. I'll get you more. Okay, big CPI inflation read today, right? Consumer price index. What are consumers paying for stuff, goods, services, rent, housing? Housing makes up 43% of consumer price index and inflation. Rents up 17% year over year. Home prices have been up double digits as well. It's expensive. It's expensive to put a home and a roof over your head. It's also expensive to eat. As I sit here at one of these restaurants with fire pits and fire everyone, thank God for the corporate credit card. But food, energy, rent, oil, gas, it's all gotten expensive. Used cars are up 40% year over year. 40% year over year for a used car. A used car, not a new one. Can't get as many new ones because there aren't as many semiconductor chips being made. For people on the lower end of the socioeconomic scale, it has gotten expensive in many urban areas. That's why you see this continued migration of working from anywhere, people moving to outskirts and moving to other areas. That's going to continue. But a 7.5% CPI read today is the largest in 40 years, since 1982. If you take out, you strip out food and energy, the core CPI, 6%. That's a lot. I mean, that really cuts into the value of your cash. Cash is trash right now. Having said that, the dollar is strong compared to the rest of the world, because the rest of the world is strong as hell pre-pandemic, but since they suffered the pandemic, their economies are not doing well. America is the shining beacon of the world. You got Germany with slowing growth. You've got China with slowing growth. They're in their own housing recession. Oh, we got a couple stragglers here for the PRMG sales rally. Let's go. Yes, there you go. Don't look too excited. There was a bar there earlier for like 3 hours, so these are your diehards. Anyway, you guys know I always like to be the last one around, shut the party down. But these other economies around the world, they're not doing great, even though we're generally coming out of a pandemic. And so what, right? What does that have to do with us here in housing? Our interest rates, if you look at it, are predicated on what the Fed will do and how strong our economy is. And what's interesting is literally just a couple weeks ago, we had one of the strongest GDP quarter reads in a long time with a 6.9% growth of our gross domestic product. And we're already talking about a recession. Immediately, that's how fast the equity markets, the bond traders, that's how they start thinking. What's going to happen with the Fed? Are they going to raise 3 times this year? Are they going to raise 50 basis points here in March? Are people in the moment because of this high CPI reading and saying, all right, it's no longer a quarter in March, it's going to be a 50% Fed rate hike? We don't really know. We had the pleasure of having a 3-time Crystal Ball Award winner, Barry Habib, speak today at our sales rally. And it was really fascinating to hear his take on what's going on right here in this moment. And when he called me in the audience, I was on the phone listening to his son, Dan, give a market update. So it was pretty cool getting real live time information from an absolute expert and well-known industry veteran, and of course, a dear friend of mine. But let me just say, The Fed, when they raise rates and you have this high of inflation, it's almost always a sign of an impending recession. Now, it's kind of easy to say that because there's always going to be a recession in the cycle coming around the corner. When will it come? What will bring it on? Will slowing growth and demand in Germany and China, will that be the reason? Is that what's going to push us into it? Is the Fed raising rates while those economies are potentially lowering their rates? China did a Fed rate, their version of Fed, they did a rate cut. England raised their rates. We have to look at bonds around the world. You look at German and Japanese bonds, what's going on with their debt. Logan Motoshami, lead housing analyst at Housing Wire, talks about it all the time. When those bond yields go up, you tend to see our bond yield go up. And today, the 10-year closed over 2%. Hasn't happened in almost 3 years. So that's a sign that inflation is a big deal. That's a sign that the Fed is going to raise rates potentially 50 basis points, potentially multiple times this year, maybe a quarter each, 50 on the first one. We don't really know. There's still some uncertainty. But what's interesting is if we're behind the curve, the Fed's actions are behind the curve, trying to play catch up, raising rates, and they end up stalling out and putting our country into a recession, that's a big problem. And it's just crazy. We're talking about recession right now. But you know what? 70% of our economy's growth is through consumer spending. Demand destruction comes from a couple different ways. People just flat out refuse to buy that new car. They refuse to use gas. They don't take those road trips. They don't buy that extra item, those goods, those services. They hunker down. They save. They decide, you know what? Things are just too expensive. I'm going to chill. I'm not going to buy houses because they're too expensive. And that ends up bringing inflation down if the demand is not there. And then maybe all these warehouses around the world that are trying to catch up bring in some oversupply. And now prices tend to come back down. I don't know if our energy policy right now in our country will help that part out. So it may only be up to consumer demand of oil, heating, gas, and electricity to decide whether we can bring those prices down. It's expensive right now in our country. And if you are on the lower level, it is really, really tough just to get by. That's a damn shame in the greatest country in the world. So we'll keep an eye on the Fed and their actions and everything that's going on. Thank you for letting me ramble here for a little bit. Remember, 2022 is going to be a humongous year for purchase business. We've got to start grinding it out, doing all the work. We talked a lot about that today. Decisions, actions, results. That was the theme of the last couple of days here for us. Make a decision to build your business. Make a decision to build your purchase business and your purchase pipeline. Take action and see results. Have a great one. Cheers. Hey, it's KP coming to you live from Corona, California. This will be my only update for the week from the desk. I'll try and get one from beautiful Park City for this weekend. Yes, I'm going back. Just one of those lucky years where the calendar comes together. All right, Valentine's Day. Happy Valentine's Day for those of you that are working. I read that because it's the day after the Super Bowl and also Valentine's Day, you have this double whammy of productivity loss in America. $3.5 billion are lost today in productivity because people didn't show up to work. And if you count the time that people start to talk about the game yesterday, which was a great game. Congrats to Rams, all the Rams fans. Sorry, Bengals, man. I didn't really care either way. My Cowboys are over here. They suck, so whatever. Anyway, the Challenger Grand Christmas estimates that the amount of talking that goes on today, whether it be about the Super Bowl or the ads or the halftime show, which was awesome, especially if you're 45. I also saw, there could be people talking about Valentine's Day and what they're doing tonight. That there's another $3 billion in productivity loss today. $6.5 billion in productivity loss. Now, to be fair, it's only 9:30 here, and I'm usually here till 12:30 or 1. So if I leave here in a minute, I might be contributing to that as well. All right, what's going on in the world? Uncertainty reigns supreme, right? Russia, are they going to invade Ukraine? Are they going to go in there? Are they going to start a war? Are they going to kill people? 50,000 people could be, civilians could be killed. 25,000 Ukrainian troops. Could be a massacre. Could shut down the European oil and natural gas supply, which, 25% of the oil of Europe comes from Russia, and
3% of their natural gas comes from Russia. I don't know if that's going to happen. I don't know. It's not the biggest problem we have here in the United States. It's obviously a problem. The uncertainty that's there and the disruption that could happen to the market. If a shot is fired or something goes on, you're going to see interest rates literally get better. They call it a flight to safety. So when investors put money in stocks, aka equities, to make money, and they put money in fixed income securities like treasuries or bonds not to lose money. To think about that. So there's always this push, this pull, this tug of war, of risky type assets. Stocks responds. If shots are fired and there's uncertainty in the world, trillions of dollars, I'm sure, will pour into fixed income securities, which is actually good for mortgage interest rates, which actually bring the 10-year down, which is still kind of hovering around that 2%, that 10-year treasury. So we will keep an eye on that, certainty versus uncertainty. It was interesting, you get little tidbits of news here and there, but, what is still a problem is inflation. And, whether this Ukrainian event is a tipping point or China waits for their hosted Olympics to be over to then start messing with Taipei and Taiwan, or, no one's talking about, the crazy dude in North Korea, maybe he launches a missile and takes out a bunch of semiconductor plants in Taiwan, and he starts to saber rattle against Japan again. All these things could just be something to, make people feel uneasy. The consumer sentiment report just came out, and it was the lowest reading since 2009, over a decade. What's up with all these extreme stats, like highest inflation since in 40 years and worst consumer sentiment, and then here we're coming off a great GDP, and now we're talking about recession, and Ukraine's going to do this. Human nature is fickle, and you can see the way it plays out in the stock market. I read an article somewhere saying that housing demand has come down greatly, even though it was just a couple percent. Well, great. Maybe we need it to come down. We don't have enough supply out there. We'll get into more of that in just a second. But let's keep an eye on all these events. They certainly impact what we do, our industries, our investments, how we view housing, how we view the world. And things are expensive. I mean, inflation's a real problem here. The Fed has got to tame this. And I've never seen, Chris Whalen does a great job of putting out some articles. And I get good commentary from Paul Hinman as well. And at Grid, and they basically say, it's crazy how the Fed operates now. They have all these different officials. Some are voting members, some are not, some are governors, and they're just all out in the media talking all the time. It's like, rein the messaging in. It just confuses everybody, and brings more uncertainty to what the Fed is going to do. Are there going to be 7 rate hikes? Are there going to be 3? Are there going to be 4? Is it going to be 100 basis points, 150, 50? I don't really know what it's going to be. No one does. And so that makes people uneasy. Last week, it was very interesting. I read something that billions of dollars are pouring into short-term bond funds, like 1 to 3 month maturity bond funds. And just for the record, my legalese here. I am not an investment advisor. I'm not responsible for your losses, only your profits. This is only for informational purposes only. And we got a podcast brewing here, so you get to hear this awesome voice talent. She does a great job of telling the legalese there at the end. But just talking stocks here. Billions of dollars are pouring into short-term fixed funds, like ETFs for like 1 to 3 month bonds. PIMCO started one in 2009. It's like the most ever in 1 week put into these safe assets, this flight to safety. Remember those words, flight to safety into short-term bonds, leaving stocks. The most puts, okay, so there are options for those of you that know. An option contract represents 100 shares of a stock, for example. Well, you could trade options against the S&P 500. And I do that. I have a little trading account. I mess around, just playing around, not like a day trader. I don't stare at screens all day, but I take my little pot shots here and there. And a put option is basically betting on prices to go down, and a call is betting on prices to go up. There were more put options this past week than March of 2020, when the pandemic started. Let me say that again. This is information I saw from Stansberry Research. People are more panicked right now in the markets than they were in the midst of the recession in March of 20. Think of how crazy that is. People are on edge right now. Maybe it's because it's winter, the days are still cold and short, and they are getting brighter, they are getting longer, so spring can't come soon enough. We know it's coming soon in Georgia, but not so much in Pennsylvania. But, unfortunately, inflation's a problem. And one of the biggest things, inflation, of course, oil, heating, gas, food, but so is rent. rent is a big problem. And, rent has gone up 17%. I read a fascinating article, the Harvard Joint Studies for Housing basically said that, 17% was the year-over-year increase in rental. There's about 44 million units for rent. And I know people like to make jokes, some are serious, some are jokes about global warming or climate control or, whatever term you want to use. But about 40% of all the rental units in America, 17 plus million rental units, are in the path of hurricanes, storms, tornadoes projected this year. With this undersupply of not just single family housing or 1 to 4 units for the residential world, but the multifamily apartments and condos. What if some storms come through? Over $100 billion in damage was done just the first 9 months alone of 2021. It's not a joke. Climate change, or climate, a tornado or a hurricane or whatever, straight line, wind storms, stuff you see, in these FEMA websites, you can go see what's going on. I mean, if it takes down supply, that affects rental rates, and that is a real thing. So I thought that was very interesting to think about that. I also wanted to bring out the idea about housing, and if we do have some demand destruction, if housing prices get a little too out of control towards the back half of the year, where you start to see less buyers that are out there, if that becomes more than just a trend because it's the cold, seasonally low months, although anecdotally I'm hearing from so many people that there's undersupply in many of the major markets, then maybe the housing market gets back to a normal tone, and that's okay. Multifamily construction is at record pace. Eventually those will be completed. Framing lumber is still extremely expensive. There are many supplies that are, having a shortage right now for builders, whether multifamily or single family. But over time, will those items come down, and will the inflation rate come down? So to leave you one last point about the Fed. That everyone keeps talking about, is the Fed going to do a 25 basis point hike or 50 or 100? Are they going to do it by March, July? Are they going to do it by the end of the year? Who knows? But when no one's talking about, again, I read this article this morning in Stansberry Research. They said, what has the Fed had to do historically to tame inflation? They've had to take the Fed funds rate over the inflation rate. So it's 7.5% right now. If we moderate down to 3.5%, is 100 basis point enough? Is it enough this year? If we're going to get to 175 basis points and inflation's still at 3.5% at the end of this year, we're still off. We're not there. So inflation's still there. So people aren't talking that we may have to go a little higher than you think. Just something to think about. Have a great week. I will do a remote one if I can remember. I hope so. Have a great week. Happy Valentine's Day. And don't forget, it is still Black History Month. It's absolutely a great month. Let's talk about that. Cheers.
You've been listening to KP Talks Dollars and Cents, a top-rated show for those who want to learn about the economy and mortgage environment. Tune in each week for more episodes, and please leave us a 5-star review on Apple Podcasts and Spotify. Kevin Perenio does not render or offer to render personalized investment or tax advice through KP Talks Dollars and Cents. The information provided is for informational purposes only and does not constitute financial, tax, investment, or legal advice. For more info, follow KP Talks Dollars and Cents on all of our social channels.